Dean, could you explain covered call? Want to have some clarity on selection of call strike. First and foremost, what are you writing covered calls on? Do you have a stock position or are you doing against futures like in index futures? Let's say you buy the future and you sell a call at higher strike price, right? Something like that. So just give me a quick confirmation whether it is case one or case two. Based on that, my answer will differ. Okay, so you have stocks in your portfolio, and you want to earn some consistent income on that stock by selling either calls. You have to sell calls because for long stock position you can only sell calls. So how do you do this? Okay, simple rule, hurdles. Make sense? Now, if the market goes low, okay, you have a long stock, so it should not bother you because you're holding it for the long term. And if the market goes lower, all your call premium will be yours and you will make money. The only problem is in this case is if the market goes higher above this option, right? Now, if the stock is an all-time high, it becomes absolutely difficult to determine what strike price you can sell at. There are ways, and I'll tell you in a minute. So what calls to select becomes impossible to understand. But let's say market has fallen a lot and now it is recovering. You know that there are HVNs, last points of supply. So you can select any one of them. You can put some hurdles between the market and the short strike, similar to credit spread. All right. So let's say if you wanted to establish a bearish credit spread, what short strike will you select? The same short strike you should select for covered calls also. But if you have nothing to the left hand side, you are in an all-time high territory. How will you do this? So in that case, you can use what is called as average true range. Okay. Now, depending on how many days are there for expiry. So let's say it is the first day of the series. You look at monthly ATR for IDFC Bank. All right. And then what is your CMP? You add that ATR value. Okay, then you will get some value. So let's say, I don't know, for instance, let's say the current market price is 100 and monthly ATR is, let's say, 20. So you go to 120. Okay, now you look at 120 strike price and try to see what premium it is offering. Ideally you should use this, but if you have understood the context, if you see trade facilitation is poor, this and that, all other things, then you can come a little closer. Make sense? So that way you can try to select a strike. ATR tells you what is the average, range over the last, let's say if you're looking at a monthly chart, even if you look at ATR 14. So last 14 months, the average movement was this. You can also use standard deviation calculations, but it gets a little complicated. ATR is much simpler. So you can use simple ATR, 14-day ATR, 10-day ATR, does not matter. And see what the monthly ATR is, select, find the closest strike price, look at the premium. If that premium is okay for you, you can even go higher, all right, a little bit higher and see, and select a premium which is at or above that monthly ATR value at the start of the month, I'm saying. And, you can short that and expect the market to stay within that average true range. It can go above that. So it's not guaranteed, but there is a possibility. Okay, that is one thing. And you can make some money out of it. Second thing, let's say there are only 2 weeks remaining. Then what can you do? Then you look at weekly ATR, 10 days, 10 weeks, 14 weeks, weekly ATR, multiply it by 2 because there are 2 weeks remaining, current market price plus this weekly ATR into 2, whatever the value is, select that strike, find out what the premiums are. If you can go a little higher, it's always better. If it is very, very bad, you can come closer to the current market price if your analysis tells you that market is not likely to move much higher, trade facilitation and all those kinds of things. And all this when we are at an all-time high territory. If you have some references to the left-hand side, let's say this is the current market price and there are multiple references, put 2 or 3 hurdles between your current market price and short strike and sell here. All right. So that is how you should select strikes. But again, I'm telling you, all this is strictly for selling calls against stock position. If you're doing it against futures, the whole equation changes. Whatever I told you, it cannot be used just like that. All right. There has to be some changes, some mental changes also to be made if you're doing it against future.